Let's talk about ONGC, an absolute titan in India's energy sector. Right now, this company is a real puzzle for investors. Seriously, depending on which way you look at it, it's either a rocket ship about to blast off or a giant that's starting to trip over its own feet.
So the big question is, how can one company be sending out so many completely contradictory signals? We're going to dig into the good, the bad, and the big picture to try and figure out why the experts just cannot agree on where ONGC is headed next.
All right, let's start with the sunny side of the street, the bull case. To really get why people were so excited, we've got to rewind the clock to late 2025. Back then, a bunch of really powerful signals had investors feeling super optimistic.
At that point, the technical charts were just flashing green, all of them. The key indicators were pointing straight up, signaling some serious momentum. It really looked like the stock was coiling up for a massive jump.
And then this headline dropped, and it really got people talking. A golden cross. I know, sounds a little dramatic, but for traders, this is a classic textbook signal that can mean a huge breakout is right around the corner.
Okay, so what on earth is a golden cross? Let's break it down real simple. Imagine you have the average stock price over a short period, like 50 days, and you have the average over a longer period, say 200 days. When that short-term line crosses above the long-term line, that's the golden cross. Analysts see that and think, okay, positive momentum is building for the long haul.
And listen, this excitement wasn't just some flash in the pan based on a chart pattern. If you zoomed out and looked at the last 3 years, the stock had delivered an incredible return of almost 82%. I mean, that kind of performance doesn't just happen by accident. That points to some real, sustained strength.
And this chart right here really tells the story. That 82% wasn't just good in a vacuum. It absolutely crushed the broader market. It more than doubled what the Sensex returned in that same time frame. So this was a company that was, without a doubt, leaving the market in the dust.
And on top of all that, there was this other little nugget. The stock actually looked cheap. Its price-to-earnings ratio was way down at 8.75, while the rest of the industry was up around 15. Basically, that suggested that even after this huge run-up, the stock might still be a bargain. You were getting more bang for your buck compared to its competitors. But just when the bulls were popping the champagne, the whole story took a sharp U-turn. The good vibes from late 2025 started to evaporate, and a much more cautious narrative began to take hold. Yeah, by early 2026, those charts started singing a very different tune. The momentum that had looked unstoppable just weeks earlier, it started to fizzle out, and some serious warning signs began to pop up for anyone who was paying attention.
And here's the kicker. The very same source that was so excited about the Golden Cross was now saying things had shifted to mildly bearish. That kind of whiplash in just a couple of months, it definitely put everyone on edge. Now, the specific thing analysts were pointing to was this indicator called the MACD. You don't need to know all the math behind it, just think of it like a speedometer for a stock's momentum. And for ONGC, on both the weekly and monthly charts, that speedometer was showing that the stock was slowing down, fast. The upward trend was losing its juice.
And this wasn't just some theory on a chart, it was showing up in the stock's actual price. If you looked at the more recent one-year performance, the stock was actually down over 8%. What a complete reversal from that massive 3-year gain we saw earlier.
So here's the crucial point. This reversal was stark. While the 3-year picture was amazing, the 1-year story was the total opposite. The stock didn't just lose money, it lost money while the broader market, the Sensex, was actually gaining almost 8%. That's a huge red flag.
And there were very real reasons for this pessimism. Analyst ratings got knocked down from buy to hold. And maybe most worrying of all, the company's actual earnings were a big disappointment. Net profit for the quarter fell by almost 20%. Oof, you combine weak charts with weak profits, and you've got a recipe for concern.
So we have this intense tug-of-war going on between the bulls and the bears. To really make sense of it, we need to zoom out. We have to look past the daily squiggles on the price chart and understand what this company actually is and where it's trying to go.
And this is just fundamental. ONGC isn't just another company, it is a monster. I mean, look at this. It produces a staggering 71% of India's own domestic oil and gas. That means it's absolutely vital to the entire Indian economy. It's a true heavyweight.
But here's where the story gets really, really interesting. This isn't just about old-school fossil fuels. The most exciting part of this whole puzzle might be that ONGC is making a massive pivot towards the future.
They are aggressively shifting from being just an oil company to becoming a major player in green energy.
And these aren't just empty promises. They are putting serious money where their mouth is. They're buying up wind power assets, partnering on huge multi-billion-dollar renewable deals, and they've set this incredibly ambitious goal, a 10-gigawatt renewable portfolio by 2030. To put that in perspective, 10 gigawatts is enough to power millions and millions of homes. It's a huge deal. They're even committing to being net zero in their own operations by 2038. This is a legacy giant trying to reinvent itself for a new world.
So how do we make sense of all this? On one hand, you have fantastic long-term numbers in this bold, exciting plan for the future, and on the other hand, you have really worrying short-term signals and some pretty weak recent results. Let's try to put all the pieces together.
This table lays it out perfectly. The bull case, it's all about long-term value. You've got that incredible 3-year run, the stock looks cheap, and they're pivoting to green energy. But the bear case is all about short-term momentum. The 1-year performance is bad, the charts look bearish, and the analysts are getting cold feet. It's two completely different stories.
And honestly, this gets right to the heart of the matter. These conflicting signals aren't really a contradiction. It all depends on what kind of glasses you're wearing. Are you a trader using a microscope, focused on the next few weeks and months? Or are you an investor using a telescope, looking out over the next few years at the company's fundamental value and its big picture strategy?
Ultimately, this whole situation with ONGC is a perfect reminder that in investing, there's rarely just one simple story. It's a collection of different stories told across different timeframes. So the final question isn't really just about ONGC, it's about how you process information. When you see the so-called experts this divided, which story do you choose to follow?